Welcome back to the second session of the teleconferencing on management of financial services. So we were talking about the venture capital concept in the last session, and just in the Indian context how the venture capital is there. For a minute I will take on that, and after that my colleague will be talking to you on the insurance. So at the conceptual level, we have discussed the venture capital and what is venture capital, how venture capital fund is different from venture capital fund, and what are the ways of raising funds for venture capital funds, and how they exit, what is their role in the overall context. So in India also, these venture capitals played a very vital role. There are many financial institutions which have floated these venture capitals, like ICICI and SIDBI, IDBI, and many banks, even some of the banks also floated this thing. So broadly, depending upon the how promoters of the funds, we can we have categorized them into the funds promoted by All India financial institutions, funds promoted by state level financial institutions. For example, APIDC has its own venture capital fund, and Gujarat State Industrial Development Corporation, they have their own venture fund, and like that. State level financial institutions also floated some of the funds, and some of the commercial banks also floated their venture capital funds, and some there are some private sector funds also. There are some funds which are floated by the financial sector, private sector. So with this broad outline on the venture capital, we know that 45 minutes is a very less time to cover a topic like this, but nevertheless we have tried to cover the important things. Now we will be shifting to the insurance topic on the insurance. Insurance also in the financial services, it is an important role, because insurance also, one thing is, it is in the conceptual level, yes, it is ensuring the risks of the individual. That is one thing. But if you see it from the economy point of view, even the insurance corporations, what they are doing is they are pooling the savings of individual people, and they are also investing them in the industrial development and industrial growth of the economy. So that way, these are also acting as a financial institutions and mobilizing the surplus funds from the people who are having surplus funds to the people who are needing the funds. So to an extent, to that extent, even the insurance is a financial service, not exactly. Insurance organizations are providing the finances for the industrial growth. So with this opening remark, I would request my colleague Anjali Ramteke to make her presentation.
Hello. Good afternoon to you all. As Professor Ravi Shankar was telling you, that this is the session where we are going to speak about insurance. So basically insurance is not a term, of recent origin. Actually it has its origin almost 4,005 years ago in the ancient city of Babylonia, where the traders who used to bear risk of the caravan traders by giving them loans which they were supposed to repay at a later period when they received their goods safely with some interest. So this is how the beginning of insurance has come about. As far as life insurance is concerned, its beginning in Rome, where mural clubs were created to help those to meet the expenses of funeral expenses, as well as to help the family members of these persons. The insurance that we see today has its existence in the 17th century in London, where Lloyd's Coffee House in London, where the traders, businessmen, shopkeepers used to meet to discuss about their business as well as carry out their trades. By the end of this century, the 18th century, they had enough amount, and that was the first insurance company that came up, modern insurance company that came up. But it was around the same period that Edmund Halley has developed a mortality table providing a link between the premium, that is insurance premium, and the average lifespan based on the statistical laws of mortality and compound interest. As far as India is concerned, insurance was in existence during the Vedic period. It was around 1000 BC that there was a form of community insurance which was practiced by the Aryans, and even the name of the life insurance corporate office of the LIC has its name from the Rig Veda, that is Yogeshma. Then as insurance that we see, as we have seen that in the ancient Rome, where burial clubs were created, such kinds of clubs were also formed during the Buddhist period in India, where people, they were helping out families and houses as well as widows and children to meet their financial needs. Bombay Mutual Assurance Society was the first assurance society that was formed in India in 1870. Since then we had a number of insurance companies coming about. It was in around the 20th century or mid of the 1950s that we had almost 170 insurance companies as well as 80 provident fund societies that were formed in the country, and because of this growth of the insurance business, it was later taken up by the government, nationalized actually, and then came up the Life Insurance Corporation of India in 1956, which took over almost 250 companies. Then this particular insurance sector had remained a monopoly of the public sector for almost up to 2000. It was only opened up for private players in 2001. In 2000, December 2000, the GIC, there were only two players till then, that was the LIC and GIC. The GIC has then delinked its subsidiaries and formed 4 insurance companies. It was in 2000. Till 2001, after opening up this sector for the private players, we had almost 16 new entrants in this business, and then it has actually taken up in a big way, and presently we have almost more than 30 players in this insurance business. So we can see that it is a very huge industry that is coming up, that is the insurance. Now actually insurance, we may have this slide please. Insurance is a contract between the insured, that is the company that is providing the insurance, and the insurer, the insured, and the insured, that is the entity or person that is seeking the insurance, wherein the insurer agrees to pay the insured for a financial loss and of any unforeseen events in return for a regular payment of premium. Or in other words, what we can say that it is a system of providing protection against monetary loss that is caused by unforeseen events. the insurer agrees to reimburse a financial loss which the insured may incur due to an insured peril. Now, what do we mean by peril? Peril is an event that causes loss and the factors which have an effect on the outcome of the loss. For example, if a house is located in an earthquake-prone zone, then the earthquake that will be causing the loss is a peril. Or if it is in a area which is prone to cyclones, then the loss is caused due to flood. Then flood is a peril. Now, risk is the answer. There is always we are not very sure as to what is going to happen, or we can face any kind of natural calamities at any time. So there are a number of unforeseen events that can occur. There is no certainty of life, or we can suffer any kind of a disability. So these uncertainties of occurrence of certain events which are not in the control of human beings are to be the only answer to these kind of questions is the insurance. And basically insurance is nothing but a risk cover. Risk, as we have seen, is defined as a possibility of loss or a combination of hazards. Now, what do we mean by hazard? Hazard is actually a condition that increases the chance and the size of the loan. Now, your house is located in an earthquake-prone zone. Naturally, the loss that is caused due to earthquake will be more in this case. That condition itself is a hazardous condition. So that is hazard. Now, the hazard is further classified as physical hazard and moral hazard. Now, the hazard that arises due to the characteristics or physical characteristics of an object is what is a physical hazard, whereas there are certain other kinds of hazard which are done intentionally, wherein the attitude of the insured person comes into play. That is the moral hazard. Now, for example, almost all of you have your vehicles insured because it is compulsory. Motor insurance is compulsory. So, if someone, probably we can take the example of heavy vehicles, wherein if some few of them do accident, intentionally accidents are done in order to claim insurance, then this is what is a moral hazard. There is another form of moral hazard, that is the legal hazard, and this legal hazard can result from laws or regulations that force insurance companies to cover risks that which they would have not otherwise covered. And the best example for this is the inclusion of alcoholism in health insurance. Insurance itself is, if we can see, is a moral hazard, because the sense of security that once the property is insured, we try to be negligent and we don't try to take precautions which are very necessary to prevent those loss that are going to occur. For example, if we have taken fire insurance, we may not take up necessary precautions in order to avoid fire, or we may take up risky things and then this gets which may lead to the loss. So this insurance itself can be a moral hazard. So basically insurance is risk cover. Now risk can be categorized into different categorized as objective risk and subjective risk. These two, financial risk and non-financial risk, pure risk and speculative risk. The objective risk and subjective risk are actually concerned with events that may or may not produce financial loss. Now, objective risk is something that is related to the relative variations in the actual loss from what was assumed or expected to be the extent of loss. whereas subjective loss is something that is referred to the mental state of any individual who experiences doubt or worry about the outcome of a given event. Financial risk is a risk that results into any kind of monetary or financial loss to a person. Now, as we were taking the example of vehicle, now for example, if your car get damaged, then the loss owner definitely suffers a loss. That is a financial loss to the owner. So this is a financial risk. Whereas if in that same accident, if something happens to the person who is there, means for example, if you are there in the vehicle and something happens to you or some disability occurs to you, then the grief or sorrow that you, or the sufferings, your sufferings as well as the sufferings of your members of your family are they cannot be counted in monetary terms, and these kind of risks are the non-financial risk. The third category of risk is the pure risk and the speculative risk. It is actually the situation, a pure risk is a situation where either you have a financial loss, either you have a loss or you don't have a loss. There is no probability of any gain in case of a pure risk. Whereas in case of the speculative risk, there is a chance of a loss or a gain. Now, in insurance, only the pure risk are provided, means insurance is provided for pure risk, whereas for speculative risk, no insurance is provided today. Because speculative risk, as we can see, the prediction of the loss or the gain means the loss or gain is not certain. People do enter into these kind of risk intentionally or in order to gain profits. So it has benefits to the society, and these kind of risks are not included in, mostly not covered under insurance. Whereas the pure risk, where there are a chance of a loss or a loss not occurring. Now, for example, we all take life insurance policies. Now, it's not means that is the person will die before the maturity of that policy, means it is not certain when the person will die. So there is an uncertainty whether there will be a loss or there won't be a loss. So these kind of risks are what we call as the pure risk, and pure risk are actually provided, means they are included in insurance. The fourth category of categories of risk are fundamental risk and particular risk. Now, there are certain risks which affect a single individual, or they may affect a group of individuals. Now, any risk that affects a particular person is a particular risk, whereas the fundamental risk is a risk that affects a huge number of people, or means in earthquake we have a devastating effect, and it may cause damage to property, people, cattle, etc. So there may be a loss, means the losses on a group of people. So it is a fundamental risk, whereas a particular risk is wherein a loss occurs to a particular person. In the example that we were taking earlier, that is where there was a car damage to a car, then that risk is a particular risk. Even in case of terrorism, that could be taken up as a fundamental risk. Now, pure risk are actually classified as personal risk, property risk, and liability risk. Now, personal risk are risks which directly cause, personal risks are directly causing loss to a particular person. Now, for example, if the death is no doubt certain, but the time when it will occur is not certain. So this is the most important contingency that is covered under insurance, because for any individual, the most important asset of any individual is its earning capability. Now, if a person loses its earning capability, or someone who are dependent on him or he may suffer a great loss. So these kind of contingency, this contingency is the most important contingency that is covered under insurance, and that is the risk of premature death. Because the untimely death of any person creates the substantial financial problems to the dependents of that person. The second that we have is the risk of living too long. Now, this is the second contingency that we have in personal risk. In almost all countries today, the mortality rate is continuously decreasing. So, in order to meet the expenses after retirement, the person has to have needs finances to meet his needs as well as the needs of his spouse. So these kind of risk of living too long is the second most important contingency that is covered under insurance. Now, the risk of unemployment. This risk, as we have seen very recently, that people have suddenly lost their jobs in the jet airways. So actually these kind of risks are not means insurance is not provided for these kind of contingencies in India. But of course in the United States there are various programs under which these kind of risks are covered. But even today, when there are so many private people working in the private sector in India, and there is a continuous threat to their jobs, or they have an uncertainty or risk of losing their jobs, the risk of unemployment is not covered under insurance. Then lastly, we have the risk of illness or disability. This is another very important aspect, because risk of disability means this not only has an effect on the earning capability of a person, but it has a devastating effect by adding on the cost of meeting the additional expenses that the person has to incur in order to rehabilitate himself or to undergo various therapies. So this is a very important contingency that is covered under insurance. Then we have next is the property risk. Now, property risk affects either person or real property. Normally, two types of losses associated with destruction or theft of property are the direct loss and the consequential loss. Now, direct loss, for example, if in case of if you all have a vehicle. Now, in case or if we can take your example, sir, if your car is stolen, then in that case, the loss that occurs to you because of that your car has been stolen, then this theft, that there is a direct loss to you in financial terms. But if you hire another vehicle to meet for using, then
and if it gets stolen,
no, not it gets stolen, but the rent that you pay for hiring that vehicle, that is a consequential loss. So this is in addition to the damage that has been already done. So these are the two losses that come under property risk. Then third very important risk is the liability risk. This liability risk is of great importance because under law of the land, and a person can be held legally liable if his/her act results in serious bodily injury or property damage to someone else. You can be sued for having done for neglecting, or you have done something very intentionally and which causes damage to some other person. Then in that case, the financial loss occurs to you. You will have to pay for the losses. Now, for example, in professional risk, if there are accountants or engineers, and means if something happens, then they will have to bear for this risk. That is the professional risk. For I think we can take the example of doctors. If something wrong goes on the part of a doctor, then the patient, if he is not cured or anything happens to him later, or there is any mistake that occurs on his part, he can be sued for that action. So this is what comes under the professional risk. Or even, for example, if a product, if a consumer finds any problem with the products, he can claim against the company. So this is what is the product liability risk. Now there is...
If a consumer consumes something, because of that if we fell ill, then it becomes a...
No, if there is a problem with the product, then...
No problem, okay. Because, see, you are saying, no, because of that consequence, if something happens, then it becomes a risk, no?
Products that harm or injure customers, then that is a product. Then there is another form of risk, that is the, actually liability risk itself can be called as a legal risk, because there is a possibility of loss if found liable for the financial loss incurred just defending. Means you may have a financial loss not only because you are found to be liable to have done that act, but also because even if you are not found liable, then the financial loss incurred for defending yourself is also there. Now, according to the coverage of insurance, insurance can be classified as life insurance, non-life insurance, and yes, of course, life insurance is something that we all are very familiar with. It is associated with human life in general, and it can be covered up to the limit that is specified, that is called the sum assured. And two most important are the life and health insurance. In contrast to the life insurance, we have the non-life insurance, in which the insured is indemnified or provided with compensation in the event of operation of an insured peril. Now there is another very important form of insurance that is coming up these days, is the microinsurance. Now, microinsurance is actually a form of insurance which covers health, property, and also life of it provides insurance which covers all this for a limited, and it provides a limited protection on the basis of a low contribution. Hence, it is called micro. And basically, the target group in this is the poor sections of the population, and it is designed in such a manner that it helps to cover themselves collectively against risk. Hence, it is insurance. So, this is something that has come up very late, in the past few years that has come up, is the micro insurance. Normally, micro insurance schemes are linked to associations, or they are provided through associations such as the NGOs or the health hospitals or various religious congregations whose main area of work is whose main area of work puts them closer to the people or to these sections of the people who can be covered under insurance, microinsurance. But in many cases, it so happens that these people are not taking it up, but they transfer the risk of the insurance business to a professional insurer. So this is something that has come up as the microinsurance. Now, in general, non-life insurance can further be classified as property insurance, then liability insurance, which and where we have a number of policies in the non-life insurance, that is fire insurance, then cattle insurance is also there. So there are a number of non-life products in the insurance sector. Now, the characteristics of insurance. Now, as we have seen that in insurance there is a pooling of risk. The loss suffered by one is spread across. It is spread across the group. That is spreading of loss of unfortunate few over the entire group. So that is what is pooling of risk. That is risk pooling. That is the most important characteristics of insurance. Then, of course, it is a business that deals with the transfer of risk only. That is, the risk is transferred from the insured to the insurer. And thirdly, is the third characteristics of insurance is indemnification, wherein the person who is insured is re-established to his or her financial position that was there before the existence of a loss or the event that has occurred. So that is what is these are the basic characteristics of insurance. Now, what are the regulations that govern insurance? Now, as we were speaking about in the origin earlier in the session, that around it was in the early part of the 20th century that the insurance has taken up in a big way, and it was in 1912 that the first Insurance Act was prepared, and then later on there were many amendments that were made to it, and then we had the Insurance Act of 1938. Because the mid-1950s there were a number of insurance companies that were formed, as around 170, and the Provident Fund societies more than 70. So in order to regulate this business and to avoid irregularities and scams, the government has then brought in this, set up the insurance LIC in 1956. So all these were governed by the Insurance Act 1938. It was only in 1999 that the Insurance Regulatory and Development Act was prepared, and before the opening of the insurance sector for the private players in 2001. The mission of this Insurance Regulatory and Development IRDA is to protect the interests of the policy holders, to regulate, promote and ensure orderly growth of the insurance industry, and for matters connected therewith or incidental. Now, IRDA was set up with the statutory powers to function as the regulator of the insurance industry in India. Since then, IRDA has come up with regulations on various aspects of insurance business, such as the licensing of the agents, solvency margin for insurers, accounting norms, investment norms, and registration of the Indian insurance companies, etc. It was not only that, but the Reserve Bank of India has also allowed banks to enter into the insurance business, and for this they have issued a notification specifying insurance as a permissible form of business uh, under their section 610 of the Banking Regulation Act 1949, thus opening another avenue for the banks for generating their fee-based income. So these are the regulations that we have in place in the insurance business. Now, as far as the grievance redressal is concerned, now to protect the interest of the policy holders, we do need to have some place to wherein they can get their problems or complaints registered. So the grievance customer cell of the insurer, this is the first place where if the policy holder or the insured person has any complaint, then he has to first give a representation to the grievance customer cell of the insurer. In case if he is not satisfied with the response that he receives from his insurer, or if there is no response from the side of the insurer, it is not settled, then he can go to the grievance cell of the IRDA. There is a special cell created, grievance redressal cell of the IRDA, which looks into these complaints. There is an insurance ombudsman. This has been created. The institution of insurance ombudsman was created by the Government of India for the quick disposal of the cases that were there, insurance complaints of the aggrieved insured persons or claimants who could not get their complaints redressed by insurers. For them, this insurance ombudsman was created. Now, this actually institution is of great importance and relevance in order to protect the interest of the policy holders and also in building their confidence. As far as the RDA is concerned, from the payment. Not 20 the government now, particular here in this case, then you can go more that insurance companies, the IRDA actually does not carry out any adjudication. So insurers are actually advised to approach the available quasi-judicial or judicial channel, that is the insurance ombudsman or the consumer forum for the civil courts for such for their such complaints. Or if you are not and you have seen your access with 15 days. In it, there is a
is very important. What happens is so unless the serious face a problem. So therefore because of the accepted agreed upon treatment. Second is that so